you've got me today. Obviously not Ran. I can tell you the exact story as to why you've got me. We made a show, me and the researchers made a show for Ran. If you don't know who I am, I'm Alessandro. I make shows on the main channel. We've also got a podcast. Interestingly, we've got a podcast tomorrow with Ran, actually. Goes into a lot of detail about who Ran is. Go and check that out. I'll leave a link in the description. But anyway, I'm Alessandro, and the reason you've got me today is because I'm a researcher as well. So I help produce Ran shows every single day. And today we were building the show. We sent Ran the show, and he said, this isn't a good show. So what I really need you to do is smash the like button, because this is a show that he should have been running himself. And today we're going into exactly why Bitcoin's been struggling, crypto's been struggling, and for the most part, they've been essentially broken, right? So Bitcoin has been, since the start of the year, Bitcoin's underperformed US treasuries. It's been absolutely awful. Today, we're going to be going into what's been going on, and the only thing that I think can fix this market, turn things around, and actually allow us to start seeing some gains across our bags, across Bitcoin, across our portfolios. So if that sounds good to you, please like up the show, tell Ran exactly what he's missed, and let's get into the show. Yo, guys, thanks for being here. Let me just quickly check the chat and see who's making sure no Ran. Yes, we are in place of Ran today. Ran is otherwise engaged, and I am leading you today. So let me just share my screen quickly. Right, so Bitcoin's been crushed in the last few months, obviously since October 10, Bitcoin's just been wrecked, right? And it's hard to argue against the fact that we're in for all intents and purposes, crypto, Bitcoin has been basically in a bear market. This year, this is Bitcoin against US T-bills, right? This is awful to look at. Bitcoin's underperformed US T-bills by 9.5%. I mean, that is terrible, especially when you consider the regulatory backdrop we've been in. And this is what I mean by crypto's broken, Bitcoin's broken. If I'd have said to you at the start of the year, listen, we're going to have the first crypto president. We're going to have a completely brand new SEC, one that isn't choking crypto. We're going to have regulatory backdrops which are favorable for the entire space. There's going to be the Genius Act, which is going to try and make stable coins a staple for the entire global economy. We're going to have a strategic Bitcoin reserve executive order. You'd have said, oh, incredible. This must be good for crypto. This must be good for Bitcoin. And then you look at this and you go, year to date, Bitcoin is down against US treasuries by 9.5%. What is going on? How on earth, given the regulatory backdrop we have, how are we not doing better? Loads of tweets saying Kamala should have won. If Kamala had won, oh, what's going on here? I've just lost my screen. Let me reshare a minute. If Kamala had won, we'd maybe be in a better position. Crazy, but we are in the regulatory backdrop has been incredibly bullish, yet Bitcoin has been doing terrible. And these are the Bitcoin year-to-date return or yearly returns, right? And what you can normally see is Bitcoin goes up for 3 years, down for 1 year, up for 3 years, down for 1 year. This year we've gone up for 2 and down for 1. This isn't normal. This isn't like a typical return, especially when you consider the backdrop that we've been in over the last year. And this is Bitcoin against every other asset. Bitcoin's been doing terribly, or crypto's been doing terribly. Year to date against precious metals, it's down bad. Year to date against US tech, US equities, it's doing terribly. The only thing Bitcoin's done better than this entire year is oil. Maybe Bitcoin's digital oil as opposed to digital gold. The question is why? Why has it done so badly? And before we can answer exactly why, we've just got to understand how bad this year, relative to other assets, crypto, Bitcoin, have been. Sorry, just checking the chat. Looking at Bitcoin against Google, like you used to be able to buy one Bitcoin would cost you 680 shares of Google. Now you can buy one Bitcoin for 269 shares of Google. The same thing with Tesla, right? This is back in middle of 2024. It would cost you 446 Tesla shares to want to buy 1 Bitcoin. Now you can buy 1 Bitcoin for 207 Tesla shares. Despite the fact we are in this completely reversed regulatory backdrop where seemingly Bitcoin has everything you could possibly want it to have, it's got. It's done terrible, basically against the rest of the tech market. And normally Bitcoin trades as a tech stock, or well, trades as a proxy to the tech market, and it's really vastly underperformed. And this has led people to be like, look, listen, maybe crypto is today, maybe AI today is what crypto was in 2017. Maybe we're going to see 4 years or so of just AI being the leader, the one thing that risk appetite trends towards, and crypto just gets forgotten. You know, retail have been discovering and learning about crypto in 2017, and it became the new paradigm. And potentially now that new paradigm is shifting to AI. People saying crypto's done, people acting like it's been a normal cycle, but it's been a complete failure. This isn't uncommon. These takes are, I'm seeing these takes a lot, to be honest. The market's over, it's been hyped for years, and we've got nothing to show for it. And then you've got people even comparing the price per user of crypto users being way too expensive. So this is an interesting comparison, taking crypto versus Facebook in terms of valuation per users. How much does each user cost? Obviously, Facebook, massive company. Both these are supposedly valued on network effects, which is Metcalfe's law, which says that the more people that go and use something, the more users on the network, the more valuable the network exponentially. The value of the network increases exponentially with more users. Meta is valued at $400 per user. So if we take their amount of users, divide it by their market cap, that gets us $400 per user. If we do the same for crypto and don't include Bitcoin, like depending on which figures you take, whether that's monthly active users, whether that's you know, more broader users, so like 400 million users in crypto overall, whether that's daily active users, whatever, right? Obviously, the more niche you get, the more expensive per user. But even at a broad level, crypto is like 5x more expensive per user than Meta is. And even at like a probably more reasonable level, crypto is like almost 50x more expensive per user than Meta is. So something isn't right at the moment. Crypto search terms basically at 5-year lows. So there's no real interest in the space. If the cycle's finished, just checking the chat. Yeah, so if crypto at 5-year lows in terms of search interest, and then when you add to that recently, the ETF outflows have been pretty awful. You know, $3.5 billion in outflows this month. It's the largest set of outflows we're probably going to see. OG wallets, people who've been in this space for a very long time, have been big sellers at this stage. Now you can't see loads from this chart. It's a bit confusing, but this chart sort of shows it a little bit nicer. One thing I will say on the OG wallets selling is a real big portion of these OG wallets that are selling are sort of like 3 to 5 year holders. If I hover over here, that you can see 3 to 5 year holders, this red figure. Why does this keep turning off? Sorry, my screen keeps unsharing. Let me go back and reshare it. Very annoying. Right, we're back. So you can see 3 to 5 year holders is they've been one of the biggest sellers in the last few months. The thing about 3 to 5 year holders is actually like, you can't really say 3 to 5 year holders are like super smart money. These are guys that could have bought the top in 2021. But you can see as we go through here, people who've been holding Bitcoin for quite a long time have definitely been selling at these levels. And you can see that here. What this sort of chart shows you is that, look, a lot of people in the 3 to 5 year group have been selling their Bitcoin. Less people in the really, really high holder group, but they've been selling their Bitcoin during this period where, you know, during this period where people have been exiting their longer term Bitcoin bags. Obviously, there's been more sellers than buyers, which is why Bitcoin's come down from 120K to 80K. And again, this is basically what we all begged for, right? We begged for ETFs, we begged for institutions to buy our bags, we begged for the president to stand on a podium and call himself the crypto president. The result is that actually, like, the returns have been compressed. And if we'd have said at the start of the year when Trump got inaugurated that actually Bitcoin would be basically back to where it was when he came into power, there'd be no real Bitcoin strategic reserve in terms of them going out and buying Bitcoin and adding it to the balance sheet, we'd have been like, it's kind of disappointing. And again, if you just look at performance of alts this year, it's just so awful to look at. Bitcoin down 14%, not awful. ETH down 12%, Sol down nearly 50%. There's like 5 tokens in the top 60 that are green. The rest are just brutally red. 𝗬𝗃. If you'd have said at the start of the year, 𝗬𝗃 is going to be down 70%. I mean, people thought this was going to $20. It's terrible, terrible reading. The others chart since 2021 crushed. And the key question is, like, why has this been happening? Why, when broader tech has been expanding so rapidly, why has Bitcoin, what is essentially the bleeding edge of tech as far as our little brains can comprehend, why is it being crushed? And yes, the AI trade has taken a lot of mind share and a lot of capital and equity away from like interest in crypto. That speculative sort of like investment has basically been pulled from crypto. But the real thing, I think, that's one of the biggest reasons as to why this is, we can see here the NASDAQ, the concentration in the NASDAQ is heavily skewed, obviously, towards AI. And what we can see here in this chart, I'll just make it a bit bigger, is without, this is from Deutsche Bank. They did a press release. They did some analysis 2 months ago, so saying that, look, we think that if AI wasn't dragging the economy by the scruff of the neck along, the US would probably be in a recession right now. It would be very, very close to a recession. What does that mean? Well, it means that if the US would probably be in a recession if it wasn't for capital expenditure in AI, or the US would be very close to a recession if it wasn't for capex in AI, then actually probably the US would be close to being in a recession, right? Because what do we know about recessions? Recessions are periods of time where individuals are more afraid of spending their money. They're more afraid of spending their money because they have less wealth, because the stock market isn't as high as it otherwise would be. Because they have less of this wealth, the wealth effect is real. They go and spend less in the economy. This obviously means that GDP, etc., economic productivity ends up going down and can lead to recessionary pressures. So if it wasn't for AI, there's a very, very good chance that the US would be largely in a recession. So you've got these very separate, almost like a K-shaped situation where one portion of the economy, all the gains have come into a very small sector. All the gains have come to AI. If we look at, again, top 10 businesses in the NASDAQ, which is the tech sector for the US, account for 55% of the index. This concentration is not normal. And if we look here, the top 10 companies in the S&P 500, this one here is in 1985, 1995, blah, blah, blah. What this shows you is that today, the concentration of the top 10 companies in the SPX is greater than ever. There's basically, for every dollar that's put into the SPX, almost 40 cents of it goes to just 10 companies. And those 10 companies, you guessed it, are mainly AI-related companies. So this shows you that there's only been a small portion of the entire economy that's been pulled along. There's been a massive chunk of the economy that's been left behind. And this is what I think alts, especially alts and Bitcoin for now, why does this keep happening? Let me just reshare again. This is what I think anyway. Alts and especially, well, Bitcoin and especially alts have been largely left to the wayside. And so if we look here, let me just get my second screen up. The reason as to why this is, right? Now, there's a lot of reasons as to potentially why the vast majority of the economy has been struggling. But this is what I think. And this is evidenced by a decent chunk of economic data from previous, from essentially from history, right? These are two, this is a very, very important thing to begin to understand. This chart here shows you the 2-year yield. I'm going to get rid of the green one in a minute. This is the 2-year yield, right? This is the cost for the government to borrow money for 2 years. Right now it's 3.5%, give or take. And this is the Fed funds rate. This green line here is the federal funds rate. And the federal funds rate is obviously what we all talk about with the CME, the rates at which the Federal Reserve say they're setting the interest rate at. Generally, what you see, if we go back through history, generally what you see is that the US 2-year yield is above the federal funds rate. What does this mean? This generally means when the US 2-year yield, so you can see down here, is above the federal funds rate. Recently, it hasn't been; it's been below. When the candlestick chart is below the green Fed funds rate, it pressures the vast majority of the economy. It means that borrowing capital is expensive. It means that the smaller players who haven't got access to very good capital, very good credit, who can't have lower interest rates because they haven't got enormous amounts of collateral to put up for those rates, they struggle to take on debt. They struggle to see the ROI in taking on debt to expand their businesses, for example. And what this ends up playing out as is an economy that isn't expanding. This is the Purchasers Manufacturing Index. And this is a really, really good index for assessing what sort of condition the economy is in. And this blue line, the PMI, is a score given every month to the economy generally, and it just compares this month versus the month before, nothing else. And if the score is above 50, it means that this month the economy expanded relative to last month. And if the score is below 50, it means that this month relative to last month, the economy shrank. So it tells you over a given period, look, economy expanding or economy generally shrinking. And what you see is that when the economy expands, when the PMI tends to max out, Bitcoin price tends to max out too. You can see this here. 2013, PMI spikes, Bitcoin peaks. 2017, PMI peaks, Bitcoin peaks. 2021, the Purchasers Manufacturing Index peaks. The same time Bitcoin hit that very first peak. Yes, it went higher again afterwards. This sort of like April high is widely considered from 2021 the true high from a technical perspective, because that's when all the sort of like, bull market indicators, that's when they all peaked in 2021 at the start, at the first sort of peak. But this time there's this massive discrepancy. The PMI is underneath 50. What does that say? It says that the economy, for the vast majority of businesses, has not been expanding. Well, why hasn't it been expanding? Again, I will highlight this section here. Because for Main Street, and this is what Bessent and Trump are saying all the time, Main Street are under pressure. We want to bring prosperity to Main Street. We can't bring prosperity to Main Street while rates are too high. That's why Trump keeps saying to Powell, too late, Powell, you need to bring rates down, etc., etc. I'm going to sack you because you're not bringing rates down. Because rates have been too high for the broader economy, not AI, not capital expenditure in AI, for the broader economy to expand. This has driven the Purchasers Manufacturing Index. It's meant that it can't fully expand. And again, this is an index that basically tells you what sort of shape the broader economy is in, because it's asking people how much, or purchasers basically, how many goods and services did you buy this month? More than last month or less than last month? And really, really simply, it says, if you bought more, great, the economy is expanding. If you bought less, shit, the economy might be contracting. So that's what this is. With the Fed funds rate above the 2-year yield, which is widely considered the neutral rate that the market needs for the economy to expand, most businesses are pressured. And we can clearly see that. Oh, this is annoying me. Why does this keep happening? All right, back to the show. This chart here, there's a lot of stuff here. The green boxes are times at which the Fed funds rate, this one here, is below the 2-year yield. Again, right now the Fed funds rate is above the 2-year yield, pressure to most businesses. This chart here, all these green boxes tell you times at which the Fed funds rate and the 2-year yield were better for expansion of economies. And what you can see down here, this section down here, conditions have been much tighter for longer this cycle. This entire expansion phase of the SPX in the last 3 years has come with tight financial conditions. Most businesses are pressured. This is highlighted by the fact that if it wasn't for AI, maybe the US would be in a recession. And this is important to understand because we need this expanding of the federal funds rate, really, this expanding of the economy generally, this expanding of the PMI to truly see risk assets move, Bitcoin move, alts move, the Russell 2000 move. They need broader expanding economies. And if they haven't got that, there's no real liquidity for them to do the things we want them to do. Okay? Everyone's speaking about QT ending. Everyone's going, QT's ending soon. That means QE is going to start and we're going to just turn on the money printers and suddenly we're going to be, all assets are going to go up. This is not what happened last time. This is not what happened last time. Last time QT ended was in, basically the start of August in 2019. It was led by a 40% drop in Bitcoin if you don't include the coronavirus dump, and a 65% drop in Bitcoin if you do include the Rona dump. And last time, the runoff of how much the Fed were pulling out of the economy was basically 4 times higher than it is today relative to the total amount on their balance sheet. You can see up here, look, the Fed runoff comparison. They were basically pulling off 0.4% a month before, and now they're pulling off 0.08%. To expect QE to be turned on immediately, to expect this to turn around immediately once QT stops is, I think, a fool's errand. I don't particularly think this is an on-off switch that just gets turned on because QT stops. There is very likely a period, unless something goes wrong. Last time, something went wrong very, very quickly. Last time, the repo market blew up almost immediately after QT ended. They then turned on QE as a result of that, and markets still went, well, Bitcoin still went down. So just having QT stop, yes, it's a tick in the box of there should be more liquidity, but it's not a suddenly markets are going to go up. I do not think that's going to happen. Before we go on, we need to kind of understand this liquidity triangle, okay? Now, I put these ones in red because it gets a bit confusing. Treasury general account, the reverse repo facility, and bank reserves at the Federal Reserve. Now, when the Treasury general account and the reserve and the reverse repo facility, when they go up, that means liquidity gets drained. So let me show you on a chart what that looks like. RRP in blue. When the RRP, this is the overnight borrowing facility at the Federal Reserve, when they are adding to their balance sheet, they're pulling liquidity out of the system. When they drain their balance sheet, they push liquidity into the system. You can see this is a perfect inverse relationship with Bitcoin. Bitcoin goes up, Bitcoin goes down as soon as they start to aggressively pull off the balance sheet. Likewise, when the balance sheet goes down, when they push assets out of the balance sheet, that's liquidity coming into the market, Bitcoin can go up. So the Fed have a few different ways of bringing liquidity into markets. We know this. There's these 3 accounts, the TGA, the reverse repo facility, and bank reserves. And this is widely considered to be the liquidity triangle. Now we haven't got to go to the nth degree with this. What we need to sort of understand is that basically, recently, the RRP has been drained. There's been no fresh liquidity coming into the markets since really July. Nothing new has really come in since July. Look how high it was. It was 2.6 trillion. Now it's at, a few billion. Really small amounts have been coming into the market. Not only have small amounts been coming into the market, businesses have been pressured because the Fed funds rate, oh my God, I'm going to throw this laptop out the window. Businesses have been pressured because the Fed's funds rate has been too high for too long. Too high power, been too high for too long. So there's three of these accounts, right? You've got, I mean, this chart gets a bit confusing, but fundamentally what you can see is that the TGA, which is this green one as well, has been going up slightly, but it's not been enough to drive fresh liquidity into the market. So the TGA has been going up. That pulls liquidity from the market as well. TGA up, RRP has been basically flat. Again, the TGA, go back to this little liquidity triangle. When the TGA goes up, it means liquidity is coming out of the market. So the market's been really struggling. The Fed has been pulling money out of the economy. Businesses have been struggling under the pressure of expensive rates relative to the real going rate, which has forced most of the gains to come to a very small sector of the economy. Now, when will this change? Why is this going to change? And this is where politics, really comes into the foray, because actually now we have a situation where Scott Bessent, Trump are saying we're going to change the Fed chair, right? We know Powell's going to come to an end very, very soon. And this, again, is kind of what I think the new Fed chair is likely to bring to the Fed. Under Powell, big focus on inflation, right? He's cared less about unemployment recently because inflation has been too high. So his main mandate, yes, he's got a dual mandate. His dual mandate, if you don't know what the Fed's dual mandate is, it's to promote maximum employment as part of its dual mandate. And stable prices. Stable prices means low inflation. So the Fed tries to do two things simultaneously. And do you know what? Powell's actually done quite a good job for the most part. Markets have been okay. Inflation's been bad, but it got bad because they printed too much money in COVID. 3% inflation now, considering that they pushed out so much money into the economy back then, arguably he achieved a soft landing. However, this hasn't been good enough for, Trump, etc., because it's not been enough stimulus for Main Street. The new Fed chair is very likely going to place a bit less emphasis on inflation, a bit more emphasis on bringing rates down, and a bit more emphasis on driving economic output. This will probably come at the cost of increased inflation, is the reality. What does increased inflation mean? Probably it's good for everyone's bags. And if we look at CME, we should probably just check the CME Fed chart a minute. If we go to CME, look, and see what the rates are, the rate cut probabilities are right now, massively high for December. But if we go out to June, this is the important thing that people often are missing. People, for federal funds and stuff like that, they look always at what's happening tomorrow, like at the next meeting. The next meeting, yes, it's important, but really what's important for the broader economy is like what's going to happen in 6 months. That's what markets are pricing in the future. What's happening in 6 months? In 6 months, in June, there's a very, very good chance, in fact, like a 40%, 40, 30, 70, basically an 82% chance that the federal funds rate in 6 months will be underneath this bar. What does this mean? It means that in about 6 months, there's like a 3/4 chance that suddenly financial conditions will be okay for expansion. Where was I? I was here. Because the federal funds rate will be 3.25 to 3.5% or lower. There's only a 20% chance at the moment, 17.2 plus 2, so 19% chance that they're still going to be above this green line. What does this tell you? It means that at some point in the future, very likely, fresh liquidity is going to come into the markets. Markets will be less pressured there'll be more expansion. We'll probably see, crypto search terms. Where was that? Where was that? Crypto search. We'll probably see crypto search terms trend upwards again, because suddenly people have a bit more money in the short term. Yes, inflation's still going to make the wealth divide, the wealth gap, probably bigger over time. It's probably not going to solve any of the long-term currency debasement issues at all, but it's going to mean that there's going to be fresh liquidity, most likely, that comes into the riskiest portion of the economy. Crypto is a large benefactor of that liquidity, and it hasn't had it all year, which highlights the fact that we've been struggling all year, and alts have just been crushed. We know Trump is probably going to replace Powell. Well, he's definitely going to replace Powell. He's been sharing memes of him firing Powell all year. This isn't happening until, June, give or take. There's a very good chance it's going to be 𝗕𝗏𝗄𝗃. He was the one who dissented at the last federal meeting. That means that he went against everyone else and said, what you're doing is wrong. We need more rate cuts. He wanted a 50 basis point rate cut. Again, he's the next Fed chair. Whether it is him or not, he is the high likelihood right now. Whether it's him or not, who knows, but very, very likely. I think the new Fed chair is going to be more on the rate cut side of things, not worrying anywhere near as much about inflation and worrying much more about driving economic output at the cost probably of inflation. And there's also, this is one extra little thing in the backdrop. There's this thing called the there's this thing called the supplementary leverage ratio, which is basically like the amount of reserves or the amount of capital or collateral banks need to hold on their balance sheet to go and lend other stuff out. And there's very recently, so this was yesterday, look, there's a new kind of like a piece of legislation that's probably going to come through that means that basically banks can give out more collateral. And actually the Fed will be less required to push money into the economy. Fajal and Rao had a really, really good conversation, like a little back and forth about this. But fundamentally, what the outcome of this probably is, if it comes through, is that, look, it looks like they're gearing up for large changes, which is the magic bullet and allows liquidity provision to move from the Fed to banks at large, which means that more liquidity is likely to come into markets because basically banks want to push out liquidity because it's in their best interest, because that's how they make money. If this comes through, it's in the final rulings right now. This is another sort of like, okay, very likely at some point in the mid to midterm future, there's going to be less liquidity constraints for the entire market at large. And that kind of is the thesis. That's my thesis anyway. Oh my God, that's me. That's my thesis anyway. Is that, let me go back to myself. That's my thesis. I actually think a lot of people can be right all at once. I think people who think the cycle's over and we're in a bear market can be right. I think people who think that liquidity is going to flush back into the market and markets are going to trend upwards are also going to be right. But things don't have to happen immediately today. We can be under pressure for the next 3 to 6 months easily. There's nothing to say that, well, actually, from the thesis that I've just laid out, this thing probably doesn't really change until June. Now, maybe markets front run that. Yeah, by all means, markets are forward-looking vehicles and they should price things in. The idea what growth is priced into the market at all times. That is what a market is. It's an expectation of future returns today. The market is forward-looking. So maybe the market front runs it somewhat. But really, we're not going to see true sustained expansion. Again, this is the key thing that I'm sort of like looking at a lot of the time. We're not going to see true sustained expansion until we're starting to genuinely see the business cycle return. The stuff like the PMI trend upwards again and not be under pressure. Now, who's to say that actually when rates come down, maybe everything's completely fucked and nothing happens? By all means, that could happen as well. Maybe rates come down and all businesses that are sort of like on the verge, those mum and pop shops, continue to struggle and don't suddenly do loads better. My estimations are that actually once liquidity conditions ease a little bit and we see that the federal funds rate come down enough that smaller businesses can take on capital to start pushing money into the economy properly, I think there's going to be a decent reprieve at that point, and we should see, for the most part, those conditions that have been so tight for so long begin to ease. And we see more in line with, go back to here, we see these sort of like green boxes, these large expansion phases start to happen. And again, as I said, I think lots of people, lots of people can be wrong, right simultaneously. I think we can have the end of the cycle, plus we can have liquidity expanding. It's just that they're on slightly different time frames. And considering that alts and arguably Bitcoin has been in a bear market all year anyway, look at this. This is Bitcoin returns since the start of the year. Bitcoin returns since the start of the year. Look. What can you see here? What we've got is, normally we have this 1, 2, 3 green years, 1 red year. 1, 2, 3 green years, 1 red year. On a conditional probability standpoint, it has never happened before for Bitcoin to have 2 red years in a row. If this year's red, it arguably massively increases the probabilities that next year is not red. So I think holding on for continued bleeding from here, this is what I think is going to happen. I think we stay pressure to the downside. We're in a firm downtrend. I don't really particularly think that in the short term we break over 100. I definitely don't think we break over $108,000. I think we stay pressure to the downside until the market can clearly see financial conditions are easing enough for enough expansion. So that's what I think. Let me go into the chat and see what you guys are saying. I was assuming it was a risk on signal. XRP to 0. Can I bring this chat on screen or what? What happened to gold prices? Yeah, gold's been on an absolute tear. Yo. Constant bull market. The global economy is expanding. Yeah, I mean, like that. As I said, that's what I think. I think we see probably pressure to the downside. Yes, maybe we bounce from here. Looks like that could easily have been a local low at sort of like 80K. But I think we stay pressure to the downside for a little bit longer. I think the bear market, sort of like believers, continue to say that October 10 was the peak and we're definitely going to go to the absolute pits of hell. And I think we don't. I think we just probably, don't. And over the next 3, 6, 9 months, liquidity conditions are completely switched around, and we're potentially even having the market that we should have thought we've had from 2023 onwards. That's what I think. Let me know what you think in the chat anyway. Are we going straight down to all hell? I appreciate the kind words, you guys. Thank you very much. What's the TGA? Oh, yeah. The TGA is the Treasury General Account. Let me show you my screen again. Where did my little thing go? The TGA is the Treasury General Account, and it's just one of the accounts that basically the Federal Reserve have, and it dictates how much money is that they've got. It's access that the Treasury have to liquidity, basically. And this is one of the reasons why it's the Treasury, not the Fed, but it's the same sort of thing. This is one of the reasons why the government shutdown recently was like pressured markets so much and made almost the reverse repo market basically, the repo market basically blow up, or like really, really struggle. It's because the Fed, the Treasury couldn't spend this money because they were shut down. And so so it's the Treasury account at the Fed. It's the account that the Treasury hold with the Federal Reserve. That's what the TGA is. Let me go here, see what you guys are saying. 33K first. Oof, 33K would be brutal. I think that's pretty unlikely. As long as BlackRock and I'll keep buying, I am buying. I mean, BlackRock have been selling recently, haven't they? But yeah, it is. This is another thing. Like I didn't even go into this today, but the amount of Bitcoin that DATs hold now, that the ETFs hold now. When you account for lost coins, probably like 3 to 5 million coins are probably lost. You know, there's a guy, he doesn't live too far from me, that has got $50 billion lost in a trash, in a dump site. I mean, you can't imagine how awful that would be. His hard drive is in the dump. It's awful. Anyway, those kinds of things aren't uncommon. Probably, yeah, there is 3 to 5 million coins that are just like lost forever. That means that BlackRock, Vanguard, you know, the ETFs, MicroStrategy, all these other DATs, probably holding like 25-ish, maybe close to 35% of the circulating supply. I mean, it is getting to crazy numbers now. Right, you guys. Oh, before I forget. Ledger have an incredible Black Friday offer for you. Let me show you about it. I got to share my screen again. Let's go share screen. If you are in crypto and you do not have a hardware wallet, you need one. Let me get my, let's go here quickly. It should be in here. Let me tell you it's in here. Yes, okay, great, it's here. Let me open it for you. So Ledger have an incredible Black Friday offer. I'm actually so salty that I bought a new Ledger the other day and I didn't get this deal, so it's very, very annoying. This thing needs to stop unsharing my screen, making me feel absolutely furious. Right, let's go. Ledger have an incredible deal right now. 50% off their basically all their wallets. Now, if you don't know what a hardware wallet is, if you're in crypto and you haven't got a hardware wallet, I mean, it's such an enormous risk to not have a hardware wallet. I know it's hassle taking your tokens and putting them somewhere else, but it's the cost. It's a little bit of friction for the cost of actual security. If you hold all your wallets just in like, you know, 𝗏𝗏 or MetaMask just on your computer, it just takes one person to hack your Wi-Fi or gain access of your machine, which is not very hard because most people have pretty terrible security anyway, to take all the tokens that you've got in your wallets, which is horrible. In 2021, I had one wallet completely drained and I just didn't have a clue what was going on. Obviously, if I'd ever had a hardware wallet, it would have not been a problem. Ledgers are never this cheap, to be honest. They're always much, much, much more expensive. This is what I have. I have like 4 or 5 of these Ledger Nano X's, and 43 quid. No idea what this is in dollars. $60 maybe, and $80. These are Ledger don't really do discounts. Obviously, they're throwing in Bitcoin as well, which is pretty cool. Like the Ledger comes loaded with some Bitcoin, but these. Ledger don't do discounts really. They might do 5% off, 10% off sometimes. To be honest, I'm quite surprised they're doing a Black Friday deal. If you're in crypto and you don't have a hardware wallet, I know it feels like effort and it's friction, it's annoying, and you have to go out and buy something and then transfer stuff onto it. And you've got to do that annoying thing where you write down your keys and keep it in a safe place. And maybe you even Horcrux it out and put one in one place and 8 words in another place. That is the best strategy to do. That's what you should do. I know it's hassle, but it's like an hour's worth of work for actual security that your tokens aren't going to be taken. And I can assure you, it feels awful when you realize that all your tokens have gone because you just couldn't be bothered to get a ledger. Or in fact, actually, this is what I didn't have one for a while. And the reason I didn't have one for a while, when I first got into crypto, when I was in crypto for about a year, I was like, oh, I'll just lose it. I'll lose my keys. I'll lose the thing. I can assure you, getting your tokens actually taken is so much worse than potentially just like misplacing where you wrote your keys. Ledger, I mean, there's a link in the description. You can go ahead, click through there, and you can get these deals. I'm not even sure these deals are available on their website. But keep your tokens safe. Honestly, like it's one of those things where it's so easy to just put off, and then something bad happens, and you never make the mistake again. Humans aren't very good at taking advice from other people. Generally, most of the time, there's a lot of lessons that people have to learn. They have to go through themselves to learn the lesson, to go, okay, I've learned that lesson. I won't make that mistake again. Don't let that be a lesson that you need to learn to go and buy a wallet. Maybe you'll be all right, but that, I promise you, if you've been hacked in the past, there's no way you'll ever leave your tokens just on a completely hot wallet. Cold wallets are essential for like crypto hygiene generally. Anyway, that covers that. Check out the Ledger Black Friday sale in the description. Otherwise, thank you so much for joining me. Make sure to like the video and tell Ran exactly that he should have taken this show on. I'm not really sure why he was so against it. I think the thesis on this is very strong, but by all means, let me know in the comments. Tell me what you think of the thesis. Do we go up? Do we go down from here? Will there be a wave of liquidity that comes in? And will the liquidity even save us? Yes or no? Who knows? I gave you my ideas. Tell me yours. Thank you ever so much for watching. I shall see you, hopefully, actually, for some lives very, very soon, because Ryan's going on holiday middle of next month. I might be taking some more slots. I shall see you soon. If not, I'll see you on the weekend. And if you could be so kind, go and check out Risk Takers. We've got a show with Ran. It goes into like who Ran is, his upbringing, sort of like, it's a really, really amazing show. It's launching tomorrow. I'll get the guys to put a link to it in here. Well, a link to the podcast YouTube channel. Ran's show drops tomorrow. Please go check it out. Otherwise, have an excellent day. I shall see you soon.